everybody's making their own analysis if it comes to inflation. Geopolitical tension, that's more difficult.
With Russia's continuing its buildup of its forces, we are ready no matter what happens.
Well, either my right honourable friend had not read the rules, or didn't understand what they meant, and others around him, or they didn't think the rules applied to number 10.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Johnson under fire once again. A report criticizes failures over partygate as the Prime Minister faces growing Tory fury. The diplomatic fury over Ukraine continues while Blinken speaks to his Russian counterpart after a sharp clash at the United Nations. And UBS beats on net income. The Swiss lender raises litigation provisions. We're live from Zurich this hour. Now, first thing is first, let's check in on the markets after we had that rally in the Nasdaq, filtering through to some of the European stocks, and actually the European financials also doing quite well. So if we get onto the markets, I can tell you exactly what's going on. You can see financial services, one of the biggest gainers in today's trading session. UBS actually gaining some 7.5% just a short while ago. Now, the picture overall for European stocks is one of gains. We have a lot of earnings, and my fact of the day is that 80% of earnings so far in the U.S. either beat expectations or came in line, which is why we're seeing more banks saying now is the right time to buy the dip. UPS, you can see gaining some 6%, and then this is a Bloomberg commodity index. Always a good idea to look at what it means for commodities, given we have OPEC plus a little bit later on, and of course, given the tension over in Ukraine. We just had a good and robust conversation with the Executive Vice President of the European Commission, Mr. Valdis Dombrovskis. Now, the picture overall is, of course, not only does the wall of worry not go away, and I'm thinking of Fed hikes, but also the fact that Omicron is still large. So we'll see how it plays out over the last couple of days, whether a lot of the volatility infects some of the stocks or whether it's a pure currency play. Currently, you can see the UK and the FTSE getting some 0.8%, similar gains or higher gains actually for the DAX, the FTSE MIB in Italy, and the CAC 40 in France. Now let's get into the key market drivers with our markets editor, Christine Aquino. Christine, it's very clear that markets, seem to like what they saw in the Nasdaq yesterday, but can they hold on to these gains?
That is the million-trillion-dollar question today, isn't it, Francine? But it is definitely looking to be a slightly better week for risk assets. I think there's a number of things contributing to that. As you mentioned, the NASDAQ rally overnight definitely helping risk sentiment here in Europe, as is the UBS results that we're seeing today, and definitely flowing through that financial sector in the SOX 600 as well. And of course, part of that story is, of course, the expectation for more rate hikes from both the Bank of England and even the ECB, even though the latter has insisted that they're not going to be doing that, not until 2023. But markets are starting to believe that less and less. And yeah, I think also the combination of the fact that most of China markets are out for the rest of the week, given the Lunar New Year holidays, means that there is room to breathe in these markets this week. Yeah. The question is, how long do we have for that breathing room to last? Perhaps not until the next catalyst, which would be potentially the Fed rate hike in March.
So, Christine, how much of the focus, of course, will be on U.S. earnings? I mean, we have a lot of earnings today, especially some of the tech earnings. And once again, given what we're seeing with the Fed, does it put in play that 60-40 portfolio game?
Well, Francine, I think investors will definitely be watching these earnings, particularly for signs of how these companies are dealing with some of these real-world issues that central banks are having to contend with as well. I'm talking, of course, about inflation in particular. How are those margins doing? How are those supply chain issues going? We did hear some relief from Apple last week, talking about how the easing of the supply chain issues definitely providing some relief to the market. So, is that a theme that continues for all companies, not just Apple? Because, of course, Apple is in a league of its own, being a kind of cash-rich sort of company. But is that the same case for some of these smaller companies? Are they seeing the similar easing in these issues? And, of course, margins and how that's being impacted by inflation, very, very important to watch as well. And, yeah, some of these kind of macro themes that are playing out in earnings definitely would be very key to watch for this week.
Yeah, thank you so much. Our markets editor there, Christina Kino, with the very latest, of course, on what we're seeing out there. Now, happy Lunar New Year to our viewers. Welcome to the Year of the Tiger. Markets closed in China, Korea, and other Asian countries. Now, tens of millions of people plan to travel for the holidays despite high levels of COVID in some countries. Now, here's our morning must-read from Bloomberg Opinion's Mark Gongloff on the U.S. and China. And Mark writes, though it may be condescending and leaves the toilet seat up even after you tell it a million times to put it down, the U.S. is still China's most important trading partner. A little more self-sufficiency could not hurt or couldn't hurt China, but shutting down this symbiotic economic relationship would actually lead to stagnation and unrest. So to talk about the markets, but also this odd and fraught relationship between the U.S. and China, joining us now is Silvia Ardagna, head of European Economics Research at Barclays. So Silvia, thank you so much for joining us. First to the markets, and actually what we're seeing out there is an uneasy relationship with what the Fed does to fight inflation. Have you had to revise up your calls for Fed hikes, and what does that mean for some of the European research you're doing?
Hi, good morning. Not recently. We have not changed the Fed call, really in the short term. We were expecting the Fed to signal a rate hike coming in March, and we have 3 more in the rest of the year with some quantitative tightening starting in May. Now, for the European implications, we continue to think that Europe is in a different business cycle stage relative to the US, and so we don't have a hike from the ECB this year. We actually have it later on in 2023. Clearly, we are seeing inflation remaining higher and more persistent than we thought, but we think that second-round effects are not evident and wage growth remains pretty lackluster. We will have some increase in wage growth, but it will come only later on in the year when wages begin to be renegotiated in various countries. So I think the ECB has time to remain patient.
Silvia, what does it mean for actually, a policy mistake that we could see from the ECB? Where would it come from? And to our point about the Chinese Lunar New Year, is this the biggest risk to Europe that actually China does a policy mistake and we feel the effects here?
Look, for the ECB, with the euro area is growing well. Finally, we have got back to a pre-pandemic level of GDP, but we are not even back yet to pre-pandemic trends. So I think, erring on the side of patience is certainly being a more cautious approach than hiking soon to curb inflation. Obviously, inflation is also going to have, and high energy prices are a negative terms trade shock for the euro area, so households will be affected by that. And we have revised our growth forecast, penciling in a deceleration of growth at the turn of the year. On China, what we see is that actually Chinese policymakers are trying to relax monetary policy to try to, bring back, growth at a higher level than we had last year. So again, we don't see in our baseline case a policy mistakes on the card.
Silvia, are we underestimating, though, the impact on supply chains and also the fact that, China has not really gotten a handle on Omicron and what that means for policy from authorities?
Definitely, supply chain bottlenecks are a risk that inflation can stay higher for longer if the zero-tolerance policies will mean more closure of factories. But it's important to note that actually supply-side bottlenecks seems to be doing a bit better. We got the PMIs this morning, and if you look at the details of the releases, there seems to be some easing, at least for European manufacturers.
All right, Silvia Ardagna, thank you so much for joining us, head of European Economics Research at Barclays. She stays with us. We'll talk about the UK and the Bank of England. Coming up, the UK Prime Minister Boris Johnson faces fresh fury from his own Conservative lawmakers after a report into partying in Downing Street. We're live from there shortly. This is Bloomberg.
But firstly, I want to say sorry. And I'm sorry for the things we simply didn't get right, and also sorry for the way that this matter has been handled.
But we now know that 12 cases have reached the threshold for criminal investigation, which I remind the House means that there is evidence of serious and flagrant breaches of lockdown.
So either my right honourable friend had not read the rules, or didn't understand what they meant, and others around him, or they didn't think the rules applied to number 10. Which was it?
I told him that I thought he should think very carefully about what was now in the best interests of our country and of the Conservative Party. And I have to tell him he no longer enjoys my support.
Well, some of the fallout there in the UK's House of Commons following the publication of Sue Gray's report into lockdown parties. Now, let's get more with our Lizzie Burden, who's at Downing Street. So, Lizzie, will this be enough to convince more of Johnson's own MPs that he's just got to go at this point?
Well, Fran, we're outside Downing Street where those parties took place. They were in the report, but it wasn't able to be published in full because of the overlaps with the criminal investigation by the Metropolitan Police. And you ask how it's going for Johnson. Well, in the Commons yesterday, he had MP after MP from the opposition benches calling for him to resign. But what was more surprising was his Conservative predecessor, Theresa May, asking him whether he was either stupid or arrogant, effectively, and then a raft of Tory MPs asking him, are they fools because they followed the COVID rules, attending their relatives' funerals? But it doesn't seem like he's going to resign anytime soon, nor do we have the 54 letters of no confidence that it would take to force a vote on his future. So for now, Johnson is fighting to keep the focus on how he's going to rebuild the operation and get on with government.
I mean, it just seems, crazy that it's business as usual, Lizzie. We had a great report by Eurasia saying, look, after another bruising day, a lot of MPs will be meeting behind closed door to decide the future of the Prime Minister. He actually, Ms. Rahman of Eurasia, gives it a 75% chance that the Prime Minister is out by the end of the year. Is that what people are telling you as well?
If there's a chance that he's out by the end of the year, it all depends on the timing. We've got the local elections coming up in May, and then we've got this mounting cost of living crisis in the UK that's set to peak in April when you've got rising energy bills and rising taxes. So it's likely that the party is going to want Johnson to take the flak for that. But we may see the new leader in and debuted at Tory party conference by October. It's just we've got these two front runners, Liz Truss, the Foreign Secretary, and the Chancellor of the Exchequer, Rishi Sunak, who's going to come out the stronger appearing front runner.
Yeah, and we have a great BOE chart. Actually, the BOE hawks signal the first back-to-back hikes since 2004. What does it mean for traders?
Mm-hmm. Well, traders and economists now almost see it as a certainty that we're going to have a rise to 0.5% on Thursday. But really, traders will be looking out for clues as to how fast and how far the Bank of England is going to tighten over the course of the year. We'll maybe get a clue from that from the inflation forecast, but we'll be listening very carefully to the governor's explanation of Thursday's decision. If he emphasises the cost of living crisis, that could signal that they're worried about the immediate impact of tightening on consumers. But if they emphasise the risk of a price-wage spiral, that would signal that they are going to tighten faster through the year, and that will bring about active quantitative tightening faster.
Wonderful. Thank you so much. Our Lizzie Burden there at Downing Street. Now back with us is Silvia Ardagna, Head of European Economics Research at Barclays. Silvia, away from the political turmoil, which is actually not impacting the markets, first of all, should it be impacting the markets, or is it really all about the BOE?
Look, I think it's all about the BOE, as you say, certainly for trying to figure it out how fast and how far the Bank of England will hike this year. In our own forecast, we expect a hike, obviously, at this meeting and another hike in May, and then a pause. And a pause which is due to the fact that the economy will decelerate. This because of the energy bill hitting on consumers, but also because of the potential tax hikes that should come with the budget announced in March. So perhaps the only extent to which political events could matter from an economic perspective is really on what happens to the budget. For now, we are factoring into our forecast tax increases.
Yeah, and I think, Sylvia, that UK two-year yield actually touching 1%. What does it mean for the sequencing of what Bank of England can do? How many hikes are you expecting this year? And what does it mean for bond buying?
Well, we expect 2 hikes now, one at this meeting and one in May. So what it means that starting from February, the Bank of England is not going to reinvest maturing securities, and there is quite, a significant amount in February itself, right after the decision. But then the question is whether the Bank of England will hike more and bring the rate to 1%. If that happens, which again is not our base case, then at that point the balance sheet begins to shrink. So the Bank of England will de facto start selling some of the securities that are in its balance sheet.
But how difficult is it actually to pull off quantitative tightening in a way that doesn't upset the markets? And could the Fed then look at the Bank of England to have an idea of how to do it right?
Look, in our forecast, the Fed will actually do it starting in May. So maybe the Fed will be the leader in this perspective. And, there is a global component that of risk premium that percolates across markets. So if the Fed quantitative tightening were to impact not just the long end of the U.S. Treasury curves, but also that of obviously the Bank of England, and financing conditions were to become too tight through this global factoring, maybe that's actually a case for, other central banks not to follow with the same type of policies. But we'll see. Again, our base case is really predicated on the fact that the economic outlook will be softer next year, and that, the second half of the year, and that inflation will actually fall by then.
Yeah, so Valerie, our queen of charts, was reminding me, I think the Bank of England said they will actively be a seller of bonds, whereas the Fed will actually, had said that they will allow them to roll off. Sylvia, give me a sense of actually how worried you are about the real economy in the UK, given the cost of living is increasing quite a lot, and that's hitting households at a time where also the Prime Minister is fighting for his political survival. So will the Bank of England increase be politicized?
Look, central banks are independent, and they actually, respond to inflation or economic conditions based on their mandate. So we don't think that is going to happen. We think that it's more likely that the government will take some measures to ease the impact of high energy prices on low-income households. At the average level, there is still a pretty large buffer stock of excess saving that has been accumulated during the pandemic. The problem is more a distributional issues, that these savings are not, in the hands of the low-income households, which are the ones who are more affected by the energy bill. So we think some fiscal policies that redistribute income, so the tax hike could also finance part of these, transfers to low households.
All right, Sylvia, thanks so much. Sylvia Ardagna there, head of European Economics Research at Barclays. Now, coming up, the U.S. and Russia's top diplomats are set to hold talks today over Ukraine. We have that story next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the U.S. Secretary of State Antony Blinken and his Russian counterpart Sergei Lavrov will speak by phone today as diplomatic efforts continue to reduce tensions over Ukraine. Well, joining us now is Bloomberg's Maria Tadeo in Brussels for us. So, Maria, Russia bracing for sanctions, but is that going to deter Vladimir Putin?
Well, Francine, that is what they're hoping. And, in the interview that we just did with Valdis Dombrovskis, the idea is to hit every sector, even the inner circle. And remember, the United States says that potentially even Vladimir Putin could be hit by those sanctions to make the price so high for Ukraine that not even Russia is willing to pay it. And what they say would happen in Ukraine in 2014 is going to be nothing to the full package that we're going to see. Now, it's interesting that we're having this call today between Blinken and Lavrov. I would also point, Francine, that yesterday Vladimir Putin and Emmanuel Macron had a call on Monday night. This is the second call they have in 48 hours, and the Russians are hinting that perhaps there could be an in-person meeting between Emmanuel Macron and the Russians. It's interesting because the Russians do perceive that France is a Russophile country. It's a country that they can do business with and that they can have a dialogue. Whether or not that means that perhaps they're going for a soft spot remains to be seen.
Right, and Maria, I guess $1 million question is how do you inflict with sanctions maximum pain on Russia without hurting the European economy?
And it is for the Europeans, and I think they are pretty much aware now that this is going to hurt, and the question is how much, but also is Germany going to play ball? Now, again, in the interview that we just did with Valdis Dombrovskis, he did acknowledge that there is a conversation about how to minimize the risks, that Europe has come to terms with the idea that this will hurt, but of course, we're in the middle of winter. We know that right now we're hooked on Russian gas, and right now, this whole talk about the Green Deal and moving into renewables is just not there enough. We're still very much dependent on that gas.
Yeah, I have to say there's also a beautiful opinion piece by Javier Blas looking at, Ukraine, and there's a contained scenario and then there's a nuclear one, and he really just tries to answer the simple question, would Vladimir Putin dare? Thank you so much, our Maria, today there in Brussels. Coming up, UBS announces a $5 billion buyback after posting better than expected results. More of interview with the chief executive, Ralph Hamers. That's coming up next, and this is Bloomberg. Johnson under fire. A report criticizes failures over partygate as the Prime Minister faces growing Tory fury. The diplomatic fury over Ukraine also continues. Blinken will speak to his Russian counterpart after a sharp clash at the United Nations. UBS beats on net income. The Swiss lender raises litigation provisions. We're live from Zurich this hour. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London. Also, for our Asian and Chinese viewers, Happy Lunar New Year. Now, let's get straight to the markets. A number of countries, of course, in Asia have been closed because it is the year of the tiger. It's the first day of the tiger year, and they will remain closed for the rest of the week. The focus firmly on a lot of the technology stocks. This is after we saw that rally over in the NASDAQ and European stocks opening higher. Again, some Federal Reserve officials actually cautioning against faster than necessary policy tightening. U.S. companies also signaling another strong earnings season. In fact, out of all of them, 80% of earnings either beat expectations or match them. So we're seeing a nice little liftoff overall for these stocks. And then UBS beating expectations, gaining some 5.8%. So UBS announcing a $5 billion buyback after posting better than expected results at the investment bank. Bloomberg's Manus Cranny spoke to the chief executive, Ralph Hamers.
We have ended the year in a very good way with a core tier 1 ratio of 15%. We have a model that keeps generating capital. Our growth is capital light. We don't need a lot of capital to grow. We want to keep a strong balance sheet. However, we do have surplus capital. If you have surplus capital, it doesn't need to be used for further growth, then you should redistribute it to your shareholders. And that's why the message is there today.
Progressive is the word that's used around the dividend and payout. In terms of how the market sees you, are you trying to push out ahead as the payout bank of choice?
Not necessarily. I think what we are looking at is literally our strategy. So the market was waiting for, okay, where's the strategy going? Our strategy is to build that global ecosystem for investing. Now, building that ecosystem with our clients, with new contributors, does not need a lot of capital to grow. We grow it. It will grow in income. It will need some capital. It generates a lot of capital. Now, if it generates a lot of capital and it grows, you can do two things. You can continue to pay a handsome dividend and redistribute to your shareholders if you have a capital surplus situation. And that's what we do.
The market says 4 or 5 rate hikes. What do you believe they will do? What do you believe the market can take in terms of rate hikes without a major implosion?
It's exactly that number, I think. So otherwise the market wouldn't be expecting it, right? It's almost kind of a logic reasoning in itself. But I actually think it's about,
So just to be clear, you're going for 5 to 7?
Sorry?
You're going for 5 to 7 rate hikes?
No. This is the 4 to 5.
4 to 5.
That is exactly what is priced in the market as we speak. And I think the market can take that. And I think the Fed is just waiting for the market to have really assumed and absorbed that, and then they may do it, or they will do it. So basically they are signaling it will be coming, the market is adjusting, and then they will do it. And clearly maybe towards the end of the year, depending on how the inflation actually develops, they may either do more or less. From an inflation perspective, I actually think 2020 will be a year of two halves. In the first half year, still high inflation, but because of then hopefully decreasing tension in the supply chain, decreasing tension in the labor markets, and a more balance between the demand coming from COVID savings, for example, that from that perspective, hopefully also supported with some monetary policy there, that the inflation will be down and under control towards the end of the year. So I think it's going to be a year of two halves here.
Okay, let's see how that plays out. But inflation plays out in wages. Christian saving is seeing an increasing war for talent. Are you?
I think we're all in the same market here, right? So where we see some pressure on our workforce, we see it in the U.S. We see it a bit in wealth, Asia Pacific, because we are the leading wealth manager in Asia. And we see it in investment banking across the globe, in the banking sphere. Now, clearly, we pay competitively, we pay for performance, we have the talent to make our plan, and to the extent we need to pay up, we will do so, as we have done so last year. Having said that, we have a very good and attractive culture to work in as well. So I think there's more recipes than just pay to make sure that the people stay.
But if I look at the bonus pools around the world, Deutsche Bank up 15%, Goldman's, JP Morgan 40 to 50% up. What kind of percentage do you see the bonus pool at UBS rising this year?
I can't give the percentage yet, but it is increasing.
Well, 2020 was up by 24%.
Yeah, it is not as much as that this year. It is about paying for performance. That is what is important. And if people perform, they get paid well. And if they don't, they don't. Now, clearly, the market has done really well. We have done really well in the market, so the pay is up.
Are you paying to hire? I'm thinking in wealth, the sign-ons in investment banking and in wealth management. I'm just curious, are you paying more to bring in? Is that where the pressure is versus retention?
We are looking at retention here.
Well, Bloomberg's Manus Cranny there speaking to the UBS Chief Executive Ralph Hamers. Manus joins us now from Zurich. Manus, it was a great comprehensive interview. One of the things that really stood out for me is how much they'll invest in, of course, this automated wealth advisory, which they want to, put globally. How will that change the bank in 3-5 years?
I think this goes to the heart of the cost-income ratio in the United States of America, where, whilst it's been coming down, it's still much heavier cost burden for UBS in America relative to their peers. It's at around 80%. They've set some new cost-income targets. So robo-wealth, depending on where you sit, $250,000 through to $2 million, Francine, this is the evolution of wealth management in the United States of America. They've delivered the highest pre-tax profit since 2006 on a net income basis. The markets business actually bolstered the wealth management business, and that is rotation, according to Hamers, preparing to rotate for inflation. So the capital markets business actually did a little bit better than the wealth management, where there was that deleveraging in Asia. But you're right, this is a shift. This is about him putting his stamp on this bank 1 year into his tenure in the seat, post-Armati. This is an acquisition, $1.4 billion, and he's ready to do more. Yeah. But at the same time, do you know what, Fran? I was just watching the T Live, and on that he talks about actively looking at Europe and their presence here in Europe. That's very Jane Fraser. Prepare to pull the ripcord on certain geographies and certain businesses.
Yeah, which is why you end up with this $1 billion in savings, actually, that the market seems to like. I know there's also a debate, yes, Manus, amongst analysts in saying, look, are these new financial targets ambitious enough for UBS, given what we heard today?
Exactly, and I did provoke him with that. I said, I've had a look at these, Ralph. I said, they're not ambitious. I mean,
are you just playing it safe? He
and he chuckled.
Came back at me and he said, he chuckled, but he did come back with a riposte. So well done to Ralph, which is, look, it's not about playing it safe. It's actually about one of the series of risk hazards in the next 3 years. And interesting, his view on inflation could unseat that. Yes, you get a tailwind with net interest income, which is 100 basis points. I tried to get the seven rate hikes out of him. You know, the Jamie Dimon, Ralph Hamers spread, 5 to 7. He wouldn't go there. 4 rate hikes gives you an interest rate hike of 1%, $1.5 billion. That's the tailwind. The risk is, of course, that inflation and wages run away. Bonus pool at UBS, it's not going to be up by 24%. Hey, we actually got a news line there.
Yeah, so he basically said, you know, it won't grow as much this year. So well done for pushing it, you know, on him or trying to get an answer from Manus. But it's amazing to see, you know, the difference in that, and they can still attract top talent compared to some of their other European rivals that have more legacy issues and really at the forefront of some of the scandals again.
Francine, I have, as I'm sure you have, a number of people who work in a variety of institutions that have deferred stock from not too long ago, and it's not worth an awful lot. So what you're looking at here is a stock which is up 7.5% this morning. It's being rewarded. So as he said, there are other things apart from just pay, but I would challenge that within banking that keep you in an institution. It's pay, it's ethos, it's bonus, it's retention. It is about retention. This time last year, or in the spring of last year when we caught up with him, he was talking about junior banker pay. Now it is firmly and squarely about retention. And it's about bolstering that narrative to people to come and work with you. So let's keep an eye on it. It sounds as if they're clearing the decks on the French litigation. I'll just square off with this, Francine. This is about de-risking. So when you make the provisions, it gives you that ability to be a little bit more risque, dare I say it, on buyback and dividend.
Manus, thank you so much. Manus Cranny there. Great work in Zurich. Also wrapped up warm with a beautiful background. And remember, you can get the latest on UBS earnings reactions on our Top Live blog. It is fantastic. That together with Manus's interview on TLIV Go on your Bloomberg terminal. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Australia's central bank is scrapping its 15-month-long quantitative easing program, but says the move does not imply a near-term increase in interest rates. The Aussie dollar and bond yields whipsawed after Governor Philip Lowe pledged to remain patient in assessing inflation pressures. And I bet loads of you are playing this game right now. Wordle has been bought by the New York Times. The price was not disclosed, but the newspaper says it paid in the low 7 figures for the popular daily game, which gives players 6 tries to guess a 5-letter mystery word. The company says Wordle will initially remain free to new and existing players, raising concerns it may eventually go behind a paywall. And that's your Bloomberg Business Flash. Francine.
I can't live without Wordle. I love Wordle because you can only do it once a day, so it uses your brain, but actually not too much, so it doesn't distract you with anything else, Leanne. So it's fun, Wordle. Well, we can have a Wordle off after being on TV today. Coming up, U.S. futures rise amid a risk-on European Open. We'll get deeper into the markets conversation. That's coming up shortly, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, European equities rising this morning, tracking gains in the U.S. Tech stocks extending a rally after the Nasdaq jumped the most since March on Monday. Well, joining us now are MLive editor Eddie van der Walt and our Quick Take correspondent Alex Webb. Of course, what I'm really thinking about is Wordle, because we're just talking about 5-letter words, and I don't know whether we could describe the markets through the Wordle prism. Talk to me a little bit about technology. So it's all about games after Sony bought a pretty sexy video game player.
Yeah, so we've seen Microsoft spend a huge amount of money on Activision. Sony's responded with a smaller deal, but still a $3.5 billion deal for Bungie, which ironically had quite a close relationship historically with Microsoft and Activision. So I saw one analyst note that compared it to your enemy dating your ex-girlfriend, which is, perhaps an appropriate analogy, but it's something that, Sony really needs to chunk up to compete with Microsoft, which owns Xbox and competes with its PlayStation.
I mean, it's games that that even I knew. This, when you look at technology, so you put that to one side, and then when you look at the markets, it's still, the same concern about Omicron, what the Fed does in terms of hiking rates.
And I think this week is going to be all about the central bankers, right? We've got the BOE, we've got the ECB. I think it's going to be all about that and just about how much the central bankers are willing to push back on the hawkish narrative that the market is building, because the market has really run away with the hawkish pricing. The Fed is tilted somewhat hawkish, but the market is, looking at 5 rate hikes this year. Now, if we see some paring back of those rate hike expectations, perhaps we also see a bottom coming in for the Nasdaq.
Yeah, the thing is that earnings are so good. I think 80% of companies in the U.S. either beat expectations or actually were in line with expectations. So that would be supportive for stocks.
It will, absolutely. And the big question now is, whether we see the inflationary narrative, whether that moves on to the jobs market. And, we've got the jobs data, we've got jobs data later in the week. It really just depends on whether the central bankers are willing to go along with the ultra hawkish narrative in the markets. And at the moment, we are seeing some of them pushing back, right? We're seeing Bostic, we're seeing with George pushing back, and a few others just saying, look, perhaps it is not, we're not going to slam the brakes on the economy. Right. And in that case, then stocks are, perhaps underpriced at the moment.
And we have earnings actually from Alphabet today, which will be interesting also because of the valuation. Are we going to see more regulation this year?
Well, we're seeing some things on the European level where they're trying to push things through on the US level. It's obviously a huge amount of moving parts in US politics at the moment. With the earnings later, Google, in a sense, is quite sometimes an interesting lead indicator for consumer spending, because of course it is essentially an ad tech stock. It's brands trying to encourage people as they open up wallets to spend money with them and not with someone else. If people are spending considerable amounts more money on advertising, it means they're particularly bullish about consumer spending. If they're not, well, then the inverse is true.
I mean, I love speaking tech and putting it, compared to, for example, what the commodities index is doing. So we have OPEC Plus, and when you look at the general direction of the markets, it means completely ignoring what's happening in Ukraine or any geopolitics.
Oh, absolutely. The commodity markets, I think, have been a really good diversification play this year. As we've seen just commodities in general doing well throughout the big drawdowns that we've seen in tech and so on. And I think that probably continues. I think there will probably be this decorrelation that will continue. And there's still the overhang, the supply chain worries and so on. And OPEC's doing a fairly good job at balancing the market.
So when you look at supply chain constraints, actually, I don't know whether Apple, do we say Apple managed its supply of chip makers, and so that impacts the rest of the technology, so it'll be easier to access, or you just put Apple in another category because they're so big? Yeah,
it's very hard to sort of gauge the rest of the market by Apple, often because Apple has a very efficient supply chain machine. It gets first dibs on components for a lot of the suppliers, and it says, if you don't give us first dibs, then we won't come back to you. It's the sort of things you hear from sources. So Apple, yes, managed to overcome a lot of its supply chain problems, not all of them. And it wasn't able to sell as many iPads, for instance, as it had wanted to, because it was diverting components towards the iPhone. So it wasn't as bad as it expected, but it wasn't completely resolved.
All right, on Chinese New Year, we have to wear red. Where was the memo for Eddie and Alex? Eddie, a lot of
red-faced
markets.
Instead,
red-faced, there you go. Certainly. Let's not hope that's the case for the earnings. What are we seeing? A lot of markets actually closed. Yeah. And I don't know whether, at the forefront, we'll still see this U.S. China trade relationship.
Right. And one market where I always love to see the Lunar New Year play out is the gold market, because gold demand really dries up in the 2 months after the start of the Lunar New Year. And I think that could be the same this year again. But one big thing is that now we're pushing towards higher rates, and we're pushing, towards just a stronger dollar as well. Yeah. All of those things should be negative for gold as we go into the year of the tiger.
The year of the tiger, with maybe more regulation coming from China? Perhaps.
Well, a lot of these tech companies aren't even in China, so then they've already cracked down quite severely on their sort of domestic tech companies. I guess the concern is more about supply chain, that if their supply chain gets problems from the US, then they retaliate and make it harder for some Western companies to do business there as well.
Yeah, but gaming is quite big in China, right? And they crack down significantly on that. Is that Chinese?
Yeah, and Tencent is the biggest gaming company in the world. But we are seeing now that actually all the players are starting to get into that space when it comes, because they recognize that gaming is a building block for virtual reality and for the metaverse. And so increasingly these players, Apple and Google and Facebook and Microsoft and Sony and Tencent, are butting heads with each other.
I really want to know if they play Wordle in China as well. I don't know that. This is my own question. I'll try and answer that.
A 5-letter word will give you a lot more space in China, right? If you use Chinese characters, you could get an awful lot more into it. So
like a sentence.
Yeah.
Eddie van der Walt, of course, from our MLive team. He's editor and Quick Take correspondent, Alex Webb. Thank you so much for joining us. Now, coming up, Moderna's COVID-19 vaccine gains full approval from the U.S. FDA. We have the details next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Moderna's COVID-19 vaccine has received full approval from the U.S. Food and Drug Administration for people aged 18 and over. The shot, which goes by the broad name Spikevax, has already been given to tens of millions of Americans since its emergency authorization over a year ago. Well, joining us now to discuss all of this is our Bloomberg Intelligence Senior Pharmaceutical Analyst and EMEA Director of Research. He is Sam Fazeli. Sam, I have first of all, good morning, but I have a million questions about some of the approvals, what we're still waiting for, and what we got so far. How big a deal is Moderna?
Yeah, I mean, Francine, good morning to you too. It's the second now full approval for a vaccine. What it means for Moderna is that they can now market the vaccine. People can buy it privately, at least in the US. So it does change the dynamics a little bit. People can go and get their doctors convinced to give them a 5th and 6th and 7th and 8th shot if that's what they want. Okay. But what in reality means is that it might make life more difficult for other vaccines now that haven't been approved yet to go through the emergency use authorization pathway.
So we're also seeing Pfizer asking for approval in vaccines for the under 5s.
Yeah, so that's been something. Remember, couple of months ago, they had some data saying, well, maybe the 2 shots of this lower dose wasn't good enough in terms of antibodies. We need a 3rd dose. It seems to me now, given that we're seeing quite a meaningfully higher number of younger kids in hospital, that they're being encouraged to go and just get that approved. By the time they file and all that, they'll get their 3rd shot data.
Sam, where are we? Is it really turning into an endemic? I know there's also, studies suggesting that the Omicron variant means that you're then less likely to be protected next time around. So it's not likely to stop reinfection.
It seems like people who get a mild infection, which is what we want, from Omicron, have lower levels of antibodies than if you had had a mild infection of Delta or a severe infection of Omicron. So given that most of Omicron infections appear to be milder, that might mean that we have got less of an immune response. But remember, the question that they need to answer still, and I've just been reading the paper, is that the same for vaccinated people?
Right.
Is that the same in terms of actual protection? Because here we're talking about antibody levels. That's not necessarily the same as protection.
So I was going to ask you, how many people need to be vaccinated in terms of percentage of the population? If we stick with Omicron, I don't know if there are new variants, for it to become an endemic.
Yeah, I'm pretty sure that we still have to be at the 80-90% level to get to that.
And we're not there yet.
No, especially not in the US, which is where the brunt of the problem is occurring at the minute.
All right, Sam, thank you so much. Our Sam Fazeli there looking at everything with Omicron. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Kailey Leinz are in New York and Edwards in London. Full market roundup, of course, coming your way. Now, the focus firmly on what the Fed will do, on what the Fed has indicated. We had a number of new speakers saying they will not hurt the U.S. economy. Does that point to the fact that they may not do 50 basis points hike in March? And then this week, it's a big week for central banks. We have ECB and we have the Bank of England now priced in another increase in rates from the Bank of England. This is Bloomberg.
This is a really uneven global recovery. Clearly with a tightening monetary policy that's going to make things more difficult for equities. But, is still a year of decent economic growth that we've got ahead of us.
Markets now need to correct to some level of normalcy, and that's what we're seeing.
I think there's a lot of opportunity in some of the tech stocks that have gotten hit.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Tuesday, February 1st. Our top stories today. UBS beats estimates thanks to better than expected results at its investment bank. Now Switzerland's largest lender will boost a share buyback program and upgrade profit and efficiency targets. U.S. stocks end January with tech stocks driving the biggest two-day rally since 2020. After the closing bell, we'll get results from Google parent Alphabet. And a flurry of diplomatic activity on Ukraine. Russia's foreign minister and U.S. Secretary of State will speak by phone. Russia is set to respond to U.S. proposals on how to de-escalate the crisis. And Prime Minister Boris Johnson heads to Kiev, putting aside for the moment his own crisis at home. Welcome to the programme, everybody. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London, Matt Miller and Kailey Leinz in New York. And Kailey, so January ended with a flurry to the upside in tech stocks, and globally then we narrowed down that loss on global equities from 7% to 5%. The direction in January was pretty clear though, wasn't it? Let's see what February brings.
I think a lot of investors were very willing to bid January farewell, Anna. The question is, will February look better? Of course, we don't have a firm idea from that in Asia overnight, considering it's not just February 1st, it's also the Lunar New Year holiday, and that means China, Hong Kong, South Korea, Taiwan, the Philippines. A lot of regional stock markets in Asia were closed today. Japan was higher, and of the other regional benchmarks that are higher, you did see them moving in the right direction. The MSCI Asia Pacific Index up about 0.4%. There were a few other noteworthy stories in the region overnight, one being in India, the country's finance minister announcing spending plans that would bring the deficit to about 6.4% of GDP. That is a wider deficit than expected, and you really saw that showing up in the Indian bond market, where the 5-year yield moved up about 10 basis points to just south of 6%. And of course, the Indian rupee is also the biggest underperformer in Asian FX, weaker against the dollar by about 0.25%. Elsewhere in FX, though, I would point to the Aussie dollar, stronger to the tune of about 0.2 after the RBA ended its QE program, but sounded a lot more dovish, Matt. They say they're going to be patient, and just because QE is over doesn't mean a rate hike is coming right away.
All right, very interesting stuff to follow, and a really interesting setup in the U.S. market this morning as well. We have futures down. It's only a slight drop, 0.3%, but the real yield coming down to 73 basis points below zero, and we were climbing up to 50 just a couple of days ago. Gold coming up, 1806 a troy ounce right now. We're watching it closely because, as we learned from Eddie Vanderwalt yesterday, after the Chinese New Year, you don't have all the buying, all the demand that you have out of that incredibly populous country. And then Bitcoin, a red arrow here, but it's slightly misleading because we climbed up to higher levels in yesterday's session. Right now, 38,234 is what we're seeing for the digital currency. Anna?
Yeah, Matt, European equity markets then doing their best to try and ignore the downdraft we're getting from those US futures. So European stocks moving in the main to the upside, some decent gains coming through in some of these markets. Yes, technology to the fore, but also the earnings story and very much the banking sector. Financial services, the best performing sector here in Europe today. That's on the back of those numbers from UBS and the broader narrative from UBS. The UBS stock price up by 6.6%. Yes, they had to take another charge on litigation, but there's also the profit targets and forecasts that they've set themselves for the years ahead. They seem to have been well received by the market, and of course the share buyback going down pretty well. I put in here Ubisoft as well. This listed in Paris. It's a game developer, and this is all to do with a story that has nothing to do with Ubisoft on the face of it. This is Sony bidding for a US game maker, but it certainly gets all that chatter around consolidation in the gaming space. Such a hot topic of conversation within the gaming space, of course. Consolidation, that very much to the fore, and Ubisoft up with the sector really, but up by 1.9%. I've also got the euro in here. A move to the upside in the euro as we head towards that ECB meeting in a couple of days' time. 112.57, up by 0.2%. It's really interesting to watch what's happening in terms of the bond market action. Just in yesterday's session, the Bund, the short end, so this is 2-year Bund yield, moving up by 8 basis points in just one session. I'm told by those in the market that is huge, quote unquote, for that particular market, and certainly worth watching as we get the German inflation data coming in hot, the French inflation data coming in hot. How long does the ECB hold the current line? That will be the question later on this week, Kailey.
Yeah, market's definitely waiting to hear from Christine Lagarde coming up on Thursday. But before we can get through Thursday, we have to get through this Tuesday. And there is a lot coming up, including U.S. data with ISM manufacturing. That'll come at 10 a.m. Eastern time. We'll also get a number of earnings, including from automakers. I know Matt Miller is excited. General Motors at 4 p.m. New York time. And also after the bell, tech earnings will continue. Alphabet is next on deck, Matt.
All right, we'll definitely be watching. We're going to preview those a little bit later in the program. Right now, I want to get to European bank earnings, rolling in with the results from Switzerland's biggest bank. UBS announced it's boosting its share buyback program and upgrading key profit and efficiency targets. Bloomberg's Manus spoke with the CEO, Ralph Hamers, as the bank balances payouts to investors with the need to retain talent.
We pay competitively. We pay for performance. We have the talent to make our plan, and to the extent we need to pay up, we will do so, as we have done so last year. Having said that, we have a very good and attractive culture to work in as well. So I think there's more recipes than just pay to make sure that the people stay.
Manus Cranny joins us now from Zurich. And Manus, the market seems really focused on the buyback. How significant is the number?
It's pretty colossal. To rob Anna Edwards of her phrase, it could even be deemed as huge. They're going to be back in the market tomorrow with another $5 billion to buy back this year. So last year, 2.6, another 5 this year. That gives you 7.6 billion in terms of buybacks, the highest profit, pre-tax profit since 2006. The investment bank led the charge on this significant beat because they're preparing to rotate for more volatility, preparing to rotate for more inflation. But this buyback and the dividend narrative, to quote Ralph Hamers, is about delivering a handsome dividend policy. They made more provisions on the French litigation, and that, in his words, de-risks. It lifts a little bit of a cloud. Yes, it's $1 billion of provisions for litigation, but it does give you some more clarity about the path to higher payouts, higher dividends, and a better trajectory on buybacks.
Good morning to you, Manus. Oh, it looks cold there in Zurich. What did Ralph Hamers have to say about client risk appetite then, and that important topic of inflation?
It's interesting, Anna. They do this survey, and the sentiment is, as you could well expect, they are a little bit hesitant. But it's geopolitics rather than inflation which tops the agenda in terms of concerns. But it's so difficult to trade, as we know, to hedge, to position on geopolitics. When it comes to inflation, it is the elephant in every room, from wages to investors. It's causing the rates traders to reposition. But client sentiment has de-risked in Asia, which is reminiscent of what you heard from Credit Suisse last week in terms of leverage, trading, etc. But the sentiment I got from Ralph was, look, this can really turn on a dime, and more especially in Asia. I think at the end of the conversation, it's a CEO who's coming into his own stride. He's just spent $1.4 billion on wealth force in the United States of America, the robo-advisor. It's the way forward, everybody. Take the emotion out of those investments. And let the robo and the algo do it for you. So we're beginning to see the evolution of the Hammer era, which is about bolt-on acquisitions, $1.4 billion done. But does it translate to Europe and to Asia? That's the question that I have. And he's reviewing his current structure in Europe, which is very reminiscent of Jane Fraser at Citi. Guys.
All right, Manus Cranny in Zurich for us. Thank you so much, and great interview. Well, Manus was talking about emotion there, and it certainly was an emotional month for equity investors. But U.S. stocks ended a volatile month with the biggest two-day rally since 2020, and beaten down tech shares powered that late rebound. Alphabet and Facebook do report in the next couple of days, so bulls will be hoping for a repeat of last week when Apple and Microsoft rallied after strong results. Let's get more with Bloomberg's Danny Berger. Danny, January ended pretty well, but it was a really ugly month. How does that set us up for February?
Yeah, it's hard not to get whiplash in this market. And you could maybe take some confidence from the past 2 days, as you say, the best since 2020. But still, it was an ugly loss for the month. We did slice it in half, but that doesn't exactly instill confidence, considering it might be some of the month-end oddities of window dressing, stocking back up on tech, considering your weighting would be lower just as a function of it selling off in those Apple earnings as well. I think Jim Reed over at Deutsche Bank puts it really well when he says, until the Fed and market expectations for interest rates stop leapfrogging each other, we will continue to see volatility like this, of this whipsaw in market. Now, this this spells trouble, not just if you're a tech investor, but if you're, for example, using a strategy where you have stocks and bonds 60-40, because tech is so heavily weighted in indices, that's going to sell off. That long duration play does poorly, and bonds sell off as well. We saw it play out in January, the worst month since 2020. And to look at what this is going to do going forward, you only need to look at 2018, only the second year on record to have fallen for 60-40. That, of course, was when the Fed was tightening. So it's not just an issue with tech, it's an issue for multi-asset investors as well.
Yeah, well, it's an issue also for retail investors who don't have time to look up anything else but fall back on the 60-40 portfolio. Hey, it's a crucial week for a couple of really broadly held stocks. We're going to get Alphabet earnings, for example, Google, one of the biggest in the world.
Yeah, you have Alphabet, Google, you have Meta, Facebook parent on Wednesday, on Thursday, you have Amazon. This is the quarter that Dan Ives over at Wedbush calls the most important session in at least a decade. And that's because of the wreck that we've seen on tech due to rising interest rates. Well, can they pull it out of the bag? Can we get a repeat of last week when Apple and Microsoft earnings did well enough? Of course, the drivers for Alphabet are going to be different. It's going to be all about that ad revenue. Cloud is going to be important as well. You know, I was talking to Sophie Lund-Yates over at Hargreaves Lansdowne that said, yes, we did see Google sell off so far this year, down more than 6%. So the valuation picture is a little bit better, but it's still lofty considering its history. And at the same time, last quarter, it had really stellar earnings. So the bar is high. Good is no longer good enough, Kailey.
Yeah, even though valuations are down at 2020 levels, that's still about, 30% above the 10-year average. So thank you so much to Bloomberg's Danny Berger. Now over to geopolitics. More high-level talks on Ukraine are set for today. U.S. Secretary of State Antony Blinken will speak by phone with his Russian counterpart, Sergei Lavrov. Let's get more on this with Emily Wilkins of Bloomberg Government, who joins us now from Washington. So, Emily, there seems to be a little confusion heading into these talks about Russia's response to the U.S. and NATO's papers addressing Moscow's demands. Dmitry Peskov, a Kremlin spokesman, said they haven't set the response yet to the U.S. on security. It was a separate document on a different issue. Where exactly are we as these two foreign leaders get set to talk today?
Well, it really looks like the U.S. is taking several steps on different fronts. I mean, definitely with diplomatic, the fact that you do have Blinken and Lavrov speaking again today after they spoke so recently at the end of last week shows that there's continuing diplomatic communications between the two of them. But you're also seeing the U.S. continue to move on sanctions. You have U.S. senators say that they are close to reaching an agreement on going forward with potential sanctions, not only if Russia invades Ukraine, but simply on Russia officials right now. There's also been more movement on the U.S. telling government families in Belarus that they need to leave and evacuate the country due to the buildup that they are seeing on the Russia-Ukrainian border. So on multiple fronts, the U.S. is really addressing this, both through diplomatic, through sanctions, and then taking those preventative measures to make sure any Americans who are in the area are able to either be safe or leave now.
Emily, thanks very much. Emily Wilkins of Bloomberg Government joining us there from Washington with the latest on the geopolitics. Now, speaking of that geopolitics, Boris Johnson will be heading to Ukraine today to meet with its president. That's amid his political battle back home, of course, where he's under fire from his own conservative lawmakers after the civil servant Sue Gray put out her report, but only part of it. Let's get more with our UK economy reporter Lizzie Burden, who joins us now from Downing Street. Lizzie, what is the mood the day after we heard from this much anticipated Sue Gray report? Of course, it wasn't as complete as it might have been because of ongoing police investigations.
That's right, Anna. I'm here in Downing Street where the Johnson's cabinet is currently meeting to discuss the Ukraine situation. But this is also the place where those parties took place that are in the report and have thrown his premiership into jeopardy. Johnson is trying to focus attention on how he's going to rebuild the operation and get on with government. That's what he was trying to do in the Commons yesterday after the report came out. As you say, it wasn't released in full, only in part, but even the redacted controversion angered some of his MPs. There was a seismic intervention from his predecessor, Theresa May, when she effectively asked whether he was stupid or arrogant. Then another Tory MP asked whether they were foolish to follow the rules when they went to their grandmother's funeral. And then MP after MP from opposition parties called for him to resign. It doesn't look like that's likely anytime soon, and we still haven't had the 54 letters of no confidence that would force a vote on Johnson's future. So for now, he clings on.
All right, well, all eyes will be on the results of that police investigation. Thank you so much to Lizzie Burden, our UK economy reporter. Now let's get back to the U.S. markets and take a look at some stocks moving in pre-market trading. One mover to the downside is PG&E, the utility company, and this is after it was reported overnight it's offering a unregistered block trade via Morgan Stanley, so it's down about 2.7%. Moving to the upside, though, is Spotify, and of course, this follows a big gain for the stock yesterday, up 13.5% in the Monday session as it tries to address the issues around Joe Rogan's podcast and vaccine misinformation. It is adding to those gains today, up about 1.5% before the bell. And another mover to the upside is NXP Semiconductor. Of course, this is the second largest chip provider to the automotive industry. It reported a very bullish outlook after the bell last night. It's up about 0.8% in early hours this morning. And shameless plug, Anna, I will be talking to the NXP CEO along with Guy Johnson later on this hour, and we'll ask about those supply and demand dynamics and if it does look like it might be getting better in the second half of the year, Anna.
Not at all a shameless plug, important information. Now, coming up on this program, Kathleen Brooks, Minerva Analysis founder, will join us. We've seen quite substantial moves in European bond markets over the last 48 hours or so. We will talk to her about that. What does that tell us about the ECB? And we will, of course, focus on tech. It is a big week for tech. Tech rallies as we await earnings from Alphabet. More from Hoxton Ventures partner Rob Kniaz. He joins us later this hour. Plus, later, an exclusive interview with Philadelphia Fed President Patrick Harker. That's at 8:30 a.m. in New York, 1:30 p.m. in London. This is Bloomberg.
Welcome back to Bloomberg Surveillance, the early edition. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards with us out of London. We are simulcast on Bloomberg Radio and Bloomberg Television. And we always or often focus on the MLive blog. Today I was scrolling through it, or this morning around 2 a.m., and I saw some really cool tick data that speaks to something traders always complain about: algorithms, computers, buying and selling in the market. They've been doing a lot of selling of late, but if you look at the tick data, which is the upticks minus the downticks from the New York Stock Exchange, you can see that that selling has trailed off. In fact, we see the most bullish tick data yesterday that we've seen since March of last year. Lynn Thomason, Bloomberg managing editor for EMEA Markets, joins us now to talk about this. So, Lynn, it looks like the selling, the algo selling, has trailed off, and maybe that's a reason for the bullishness we saw yesterday.
Yeah, absolutely. I mean, I think, if there's one message you can take away from the past few days, and it's the dip buyers are back. You saw a tremendous rally the past couple of days in the NASDAQ, in everything that's been beaten down, and, really retracing some of the losses that we saw from last week. So I think that data just speaks to the fact that dip buying isn't dead yet.
Is that coming from reassurance? Good morning, Lynn. Is that coming from reassurance around the earnings story, or is it reassurance from some Fed voices? I mean, looking at what we heard from Daly and George talking about not upsetting the economy, not doing the unexpected, doing things gradually with discipline. Is that the reassurance the market is moving on?
I'm sure it's some of both, but clearly, I mean, this is a market that's hanging off of every word from Fed speakers, and I think everyone's just trying to get a sense of, what is the Fed going to do? I think clearly Powell scared lots of people with this, message of hawkishness, and now you're starting to see Fed people say, well, maybe, it won't be so bad, and you're starting to see the doves come back. So I think that's tempering a lot of the concern that we saw last week.
And it's not just the Fed, BOE and ECB on deck on Thursday. Which one could bring the bigger news, Lynn?
Well, I think being in London, I'm going to have to say we're all closely watching the BOE. I mean, I think the market is pricing in 5 hikes this year. It'll be really interesting to see whether they continue this hawkish message or whether there's a bit of dovishness that comes into the picture.
Yeah, how does that hawkish message rub up against the cost of living that is moving in an upward direction? Lynn, thank you very much. Bloomberg's Lynn Thomason from the Markets Live team. And remember, you can get all of that Markets Live blog that Matt was talking about reading at 2 a.m. in the morning. It goes 24 hours. MLIV Go. That is the function to use on your terminal. This is Bloomberg.
Time now for the first word news, and Kim Jong-un has blasted his way onto President Biden's foreign policy agenda. In January, North Korea's leader conducted more missile tests than he did in all of last year. It may be a signal he is preparing to fire a long-range missile that can reach across the U.S. North Korea wants the U.S. to lift sanctions, while the U.S. wants an end to North Korea's nuclear program. The Winter Olympics in China may be more of a drag on Beijing's regional economy than a boost. COVID flare-ups and pollution curbs are weighing on consumer and industrial activity. Plus, a ban on public spectators means there won't be the usual bump up in tourism. The Olympics begin on Friday. And Bitcoin wrapped up its worst start to a year since 2018. The largest cryptocurrency by market value was down about 18% in January. That was as we saw a broad sell-off in risk assets on the growing conviction that the Federal Reserve will soon raise interest rates. And coming up, we'll continue the conversation on the Federal Reserve and global monetary policy with Kathleen Brooks, Minerva Analysis founder. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And here is what you need to know. UBS has increased its share buyback program and upgraded key profit and efficiency targets. Switzerland's biggest lender will buy back as much as $5 billion of shares this year. Rising capital market and trading revenues led to better than expected results at its investment bank. U.S. stocks ended a topsy-turvy month with the biggest two-day rally since 2020. Beaten down tech stocks led the way. After the bell, Google parent Alphabet kicks off another crucial week for tech earnings. The company's advertising and cloud businesses are likely to be firmly in focus. And more high-level talks on Ukraine set for today. U.S. Secretary of State Antony Blinken will speak by phone with his Russian counterpart Sergei Lavrov. Russia says it has yet to respond to written proposals from the United States and NATO on how to de-escalate the situation. That is a look at what you need to know this morning. Matt, as we head towards the start of the U.S. trading session, what is in focus for you?
Well, I'm really looking closely at currencies, but before I get there, let's look at the futures. Down a little bit after the almost 2% gain that we had yesterday. So the last day of January, seeing a flurry of buying activity. We'll see what February holds. The dollar index is down right now. And if you look at the euro and if you look at the pound, they are up against the dollar. But the dollar is also down against the gold price and really against Bitcoin as well. The arrows here are kind of arbitrary because, of course, Bitcoin trades 24/7. And right now it's over 38,000. Remember, yesterday morning it was 37,000. Friday it was 36,000. So a horrible month, but it's sort of clawing its way back up. So I'm watching the dollar against commodities and currencies very closely today. Kailey, what are you watching in the pre-market?
Well, one commodity you didn't mention, Matt, is oil, which is actually moving to the downside on the day to the tune of nearly 1%. And that is weighing on some energy-related stocks in pre-market trading. The likes of Devon Energy down 1.5%. You have the likes of Marathon Oil and Occidental also moving lower. To the upside, though, semiconductors. They had a huge day yesterday. The SOX index was up about 5.4%, and those gains are continuing today. NVIDIA up 7% yesterday. It's adding to that gain, up another 1.5% this morning. And NXP Semiconductors, ahead of its earnings, was up more than 8%. It then reported after the bell last night, and those gains are continuing this morning, up about 0.8%. They are still seeing robust demand that is outstripping supply, Anna. That means their revenue forecast was a lot stronger than anticipated.
Yeah, absolutely. A focus on those supply and demand dynamics as ever. European equity markets doing pretty well to hold their heads above water, factoring in yesterday's story on Wall Street. Yesterday, you mentioned the strong run for semiconductors there, Kailey, and we've certainly seen technology to the fore here in Europe. Also financial services to the fore, and that is clearly demonstrated here by the STOXX 600 Financial Services Index, up by 2.4%. UBS is a big driver of that. We spoke to Manus Cranny earlier on. He was giving us the top line on UBS. The buybacks clearly going down well with investors, and and the fact that they have the numbers themselves and the forecast they've given themselves in terms of profitability for the years ahead. Ubisoft up by 2% over in Paris, a games developer. We've seen Sony go after a completely different company in the games development space, but as a result of that, the market thinking once again about where could we find takeover targets within the gaming sector. And so that is certainly a sector to watch this week as we talk a lot about tech and the future of tech. And we've got the euro in here as we head towards the ECB meeting. More on this in just a moment, but the euro getting gains today. We saw an 8 basis point move higher in short-dated German debt yesterday, in the yields there, and that really, as a result of that really strong German inflation data today, we've got the French inflation data coming in higher than expected. How does that reshape our expectations, Matt, around the ECB as we head there on Thursday?
I got to say, the euro dollar is killing me. You know, I sold a vehicle in Germany in euros a couple of days ago, and we were down at 111. It hurts. The video game story, I think, is really interesting. You know, we covered this a lot in my program yesterday. I recommend viewers always tune in at 1 p.m. to watch Bloomberg Markets. Sony buying Bungie, which is the creator of Halo, which basically started the Xbox, is so fascinating to me. It's also kind of the predecessor of Call of Duty after Microsoft buys Activision. So the video game war's really heating up, and obviously I am following that very closely. My gamer tag is Shower Fan. Now, joining us is Kathleen Brooks, founder of Minerva Analysis, to talk more about something more serious and macro, the Fed, the ECB, the BOE. Kathleen, what is your expectation? I guess the main question is for inflation this year. Do we see it cooling off in the second half, allowing central banks to, or allowing them not to be as hawkish as they may have had to be?
I think that's a really good point, and that's what the market is expecting. Inflation will peak sometime around the spring, and it will cause a shock for it to take longer than that to peak. So what we could see is that the hawkish central banks, the ones that are straight out of the gate, they're going to be the ones that are going to start backing away. The Fed, for example, they've massively shifted their policy stance, and they're really going great guns on inflation right now. The second half of the year, they may scale that back. Likewise with the Bank of England, but that will be probably at the time that the ECB is starting to ramp up and starting to play catch up. So there'll be a lot more divergence, or a switch in the divergence, as we move towards the middle of the year.
Kathleen, good morning. Yeah, let's talk about that divergence and how far behind the ECB can afford to get, I suppose, in terms of its timing. And it might be very warranted for it to be behind based on labour data and inflation dynamics. But the inflation surprises keep coming in Europe, don't they? And we've seen the German bond market reflecting that. The German 2-year yield is now above the ECB rate for the first time since 2015. Are we going to see, we've got a chart that shows this, I think, and are we going to see the markets just continuing to test the ECB's statements or commitments at this point that they are not minded to increase interest rates this year?
I think so. I think certainly as we lead up to this meeting in the short, very, very short term, we can see a hell of a lot of expectation that the ECB is going to start joining the Bank of England and their friends at the Fed. Right now, though, what we are seeing, what the ECB has to measure up, is the fact that they may want to push things back to governments. You pay for the extra energy bills. You support consumers through this energy crisis because we can't do this. This is an international crisis. That's what we've heard from Lagarde before. I think it's going to take quite a lot for her to change her tune. I do like the idea of a more hawkish ECB. I just don't think it's a story for today.
Not a story for today, but when does it become a story then, Kathleen? Because at the same time we have these inflation surprises to the upside for the ECB. We then get gas prices coming down because of more flow of gas from Russia through that Ukraine pipeline. It gets incredibly complex to try and work out where the energy component goes in the second half of this year.
Oh, absolutely it does. And I think that's a really, really good point. If Russia does step back further, then we could see inflation come down a lot more than we currently expect. There is an expectation that the ECB will start hiking rates by the end of this year. It's a very small hike. Maybe that will be pushed up. Maybe if we do see a bit of a shift from the ECB this week, which we think is unlikely, people will start pricing that in to come in earlier, actually, and there could be even 2 small rate hikes priced in for this year. I think it's going to take quite a lot. Inflation, even though it is beating surprises, it's still moderating from December. So that could be what Lagarde points to this week.
Of course, Kathleen, the market has been a lot later to arrive at tightening expectations for the ECB than it has been for the Fed. We actually started seeing all of those kind of Fed trays playing out at the end of 2021, including a stronger dollar. Do you think we've already seen peak dollar strength?
I think it's going to be a tricky one. I think that the euro, even though it's had a really good pullback the last couple of days, I still don't really like it. I don't like it as sustained strength, particularly against the dollar, particularly against sterling as well, particularly as in the week that we're in. I think that we could potentially move to that kind of 125 level in the sterling euro rate before we start to pull back. And I think that will come in the spring, so that over the next kind of 18 months, I think we are going to see a bout of euro strength. We've had this 12-month, or coming up 12 months of dollar strength now. I think it will shift to the euro, but I think it won't happen right now. It's going to take a little bit further, particularly if the ECB, this is a critical meeting, but if the ECB maintains its dovish stance, I think that's where you'll see the euro fall back. And it may not even keep up with the interest rates that we're seeing and the bond market, for example.
Do you expect that we'll see greater FX volatility as we move forward through these potential tightening cycles, Kathleen?
I think we've seen quite a lot already. I think we've seen some big levels, particularly in the dollar index, particularly in sterling. I think there is more FX volatility for sure, but actually what we've seen is volatility come down a little bit in the FX market. If you look at, even things like the Turkish lira, for instance, which I know we're not talking about, but that's a lot less volatile now than it was a year ago. I think that the market is focusing on interest rates. That's where a lot of the volatility is right now. That's obviously been infiltrating into the stock space, as we've seen with the NASDAQ and particularly in tech stocks, but we're potentially seeing a bit of a recovery there now. I think we're probably in for a less rough month or a less volatile month in February than we were in January, purely because a lot is priced in already.
Kathleen, thanks so much. Thanks for joining us here on set in London. Kathleen Brooks, founder of Minerva Analysis. Thanks to Kathleen for joining us. Coming up next, she just mentioned the tech story. We will discuss that in more detail. What do we expect from Alphabet earnings? We will talk to tech investor Rob Kniaz of Hoxton Partners. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. We are looking live at the Principal Room. Coming up later today, NXP Semiconductor CEO Kurt Sievers. That's at 10 a.m. in New York, 3 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Investors will have plenty more tech earnings to digest this week, with Alphabet leading the way after the bell today. Google's parent is expected to report gains in advertising and in its cloud businesses. Joining us now is Rob Kniaz, founding partner at Hoxton Ventures, and he's also a former Google product manager. Rob, nice to speak to you. Really good to have you with us on set here. I'm really interested to see what moves markets here on days where we get earnings reports, because to a large degree, a lot of these companies, you're often looking at ad revenues, aren't you? But then there are also the future growth plans and where they get their growth from, 5-10 years from now. At the moment, are we just going to be really focused on those very near-term metrics around advertising? Is that going to be the big theme?
I think it's a combination. I think people are looking heavily at the cloud performance, particularly around Google and Amazon, to see how well they're moving to the cloud, as well as Microsoft last week. These companies are staking a lot of their future gains on the penetration of cloud, which is really where it's more interesting. The ad tech is shorter term and obviously more near and more fluctuating.
Okay,
in terms of future bets, I'm really fascinated by the metaverse, especially as we navigate the return to work or don't return to work. When are we going to start seeing that kind of thing come through in results? And are Google and Amazon going to be trying to take part in the metaverse as much as Meta platform?
I think every company will have to do something. It's still early days, though. These products are still quite early, and I don't really want to walk around my house with a headset on for 8 hours a day pretending I'm in the office. So I think there's a lot to be seen with how the products actually turn out.
Yeah, and indeed, and on that subject, virtual reality, I spoke to one analyst earlier on today who's saying, look, the sale of VR headsets at Meta platforms is just a rounding error right now, but it's going to get an outsized focus because of the way that the company has staked its future on that. Is that a business that can really grow without acquisitions, or is it all going to be about acquisition strategy in that space, game makers, for example?
I think it'll have to be acquisition driven. I think these companies will have lots of innovation internally, but there's different direction things will go. And again, it's early days in the technology, and I think they're going to have to buy up companies like Magic Leap or other innovators in the space. You have to plant 1,000 seeds and see which ones actually work. And even the best companies can't predict the direction the market will go sometimes.
Well, and Rob, early days of technology, and usually as technology develops, it gets more regulated. How do you view the regulatory overhang on big tech right now?
Yeah, it's very interesting. I think there's a lot of headwinds from every government, every direction, and how to manage it. I think so far the companies have mainly managed to ride a fine line and manage some way to avoid really detrimental policy changes. But I think that's going to be hanging over their heads for years to come, and different governments will then progress and find different ways of coming after them. Google's facing even more pressure here in the UK around publishing, around paying newspapers for use of their content. I think that'll continue no matter what. People will be chipping away at the revenues of these companies.
Our London-based chart boss, Dan Curtis, is back in the office, and he put together a fantastic chart for us, Rob, on the Qs. We're looking at the biggest outflows for the tech ETF since the bubble burst in 2000. I think it's pretty amazing to look at that kind of selling. What does this mean to you? Is it a buying opportunity, or should we, head for the hills?
I think people are taking their gains to an extent in the rotation. These stocks have generally done quite well for the past 2 years. They're priced pretty heavily still, or a lot of the earnings are priced in, and there's still room for them to fall. So I think we'll know this week how they're holding up. There was a lot of, in particular in the ad space, there was a lot of questions around Apple's privacy tracking and how that's affecting Meta and Google both on mobile. They're walking a fine line themselves, and if they can keep going and keep generating the growth, then they're in a good place. But I think there's still a lot of room for errors. Microsoft had a great quarter and wasn't really rewarded publicly.
Is there a sign for you as you watch these earnings roll out? Is there a flag for you that will give you direction in terms of, okay, we need to wait for bigger drops, or now it's time to get back in?
Hard to say. I mean, for us, I think these are quality stocks in general, and these are foundational type companies that are, once in a generation type opportunities. So I think, there is a quality aspect to this where, these are the new blue chips as far as tech goes. And if you're betting on the future, you're betting on tech. So I think they're still quite a value stock to some extent, even though the prices are a bit higher, that they're still going to generate a ton of cash.
Well, Rob, let's talk about those higher prices, specifically in your role as a venture investor. How do you approach these really rich valuations?
It's hard. I think there's a lot of money on the sidelines still. If you look at the venture capital market and the private equity market, there's still a lot of money, dry powder sitting there in these funds. So to some extent, we're somewhat separated from the markets day to day, but you're already seeing some of the later stage folks worrying about multiple compression, worrying about public market exits. So, it does trickle down into the earlier stages of ventures. So, we're being cautious with valuations. At our area, we're very early stage investors. We're a bit more separated from the public markets, but we always have that in mind for 2 or 3, 4 rounds down the road. How will the markets respond to these companies, and how good is their revenue?
And Rob, when you think about conceptually what we've learned about the role that tech can play in our lives since the start of the pandemic, it's been something of a revelation for many people, and tech has stepped into spaces that we used to rely on real life for. And with that in mind, what kind of step change in valuations do you think we should have seen since March 2020 in these tech names? Because as they pull back, that's the kind of question we have to ask ourselves, I suppose.
I think these are bona fide permanent changes in the world and how people work and how people think. So, to me, this is a reasonable expectation of outcome that the world is changing fast, and these are permanent changes where people are working from home a lot more. They're hybrid working. They're using more online sites. They're ordering more online. I think customer behaviors have changed, so to some extent, the valuations are justified.
Okay, Rob, thanks so much. Thanks for joining us. Rob Kniaz, Hoxton Ventures founding partner, with his views on the tech space. And thinking about tech, coming up on programming, Alphabet CFO Ruth Porat. That's at 4:30 p.m. in New York, 9:30 p.m. in London. This is Bloomberg.
Everybody's making their own analysis if it comes to inflation there. So, but you can work with that. Geopolitical tension and the potential events coming from it, that's more difficult.
That was UBS CEO Ralph Hamers speaking with Bloomberg after the company released results that beat estimates. And of course, we're going to get a lot of earnings and economic data out over the course of today. Let's figure out what Tom Keene, co-anchor of Bloomberg Surveillance, is watching among all of that. Tom, where's your eye this morning?
10 a.m. this morning, ISM will be that first look. John Farrow tells me those are important numbers. I don't really believe in them, but Farrow says shut up and pay attention to them. So I will. What I know, Kailey, is we're seeing a readjustment here, a tweaking of the view forward with a huge fog about Q3 and Q4 of next year. Jan Hatzius and Goldman Sachs put out a stunning note where they reset. Let's look at the reset in the chart. This is inflation adjusted, real GDP, the pandemic plunge, the pandemic recovery. Down we go to a pretty good sustainable level. That circle is 6.9%. That's a big, big China-like number. And then we fade out with a grim first quarter, according to Goldman Sachs, and we move on to a fourth quarter over fourth quarter, 2.2%, which barely gets it done. You wonder, Kailey and Anna, you wonder, when did we adjust the Fed hike game?
Yeah, absolutely. The Fed hike conversation, no doubt, central. Tom, when John Farrow asks you to pay attention to things that you've no interest in, you can always tell him you're too busy playing Wordle, because this apparently is this huge, great, big phenomenon that now has been brought up by the New York Times. I don't know if you're a daily player. Certainly gets a lot of attention in my house.
Usually at parties, when Trivial Pursuit comes up, people leave the room if I say I'd like to play. I think the Wordle thing is great. I don't know if we have this yet. Brad, maybe we have this board, maybe we don't. But it was 27 days ago, the New York Times wrote up Mr. Wardle of Brooklyn, a software engineer, and his wife, Ms. Shah, and they invented this thing, and the paycheck Anna showed up yesterday.
Yeah, something in the 7 figures, the New York Times said. Pretty impressive. I already played Wordle today, for the record. Got it in 3 tries.
Did you get it in 3 tries?
3 tries, yes, I did. Tom Keene, co-anchor of Bloomberg Surveillance, thank you so much for joining us. And other than Wordle, here's what else we're watching today. I am watching Alphabet earnings. Of course, the focus is going to be pretty much as always on that advertising revenue, also on the cloud, and specifically YouTube is catching analysts' eye. And of course, anything that goes for Alphabet in regard to advertising revenue is going to read through to Meta later on this week. So we'll see what kind of growth is seen in that segment in particular, and how that sets up sentiment for the broader tech sector as we try to start February off on a firmer foot than we were on in January, Matt.
Yeah, I'm watching something more traditional, and that's General Motors, but they're being tripped up to some extent by tech issues. Now, GM has done very well in terms of margins, obviously, because they can charge whatever they want for their vehicles right now. There aren't enough out there to meet demand. The problem is they can't boost the top line as much as they'd like because they don't have the chips necessary. I'm looking, for example, for a GMC Yukon or a Sierra 1500, and I can't find the one I want, and even the ones I find don't have the features I want because they don't have the chips to heat the steering wheel or move the lumbar support. They can't bring out their AT4X pickup truck because they just don't have the chips to make it run. So we'll be watching the earnings and the call especially very closely.
It is as if the whole world is conspiring against you, Matt, what with the movements in supply chains and the euro dollar not moving in your favor. We're all here for you. It does hurt. I can understand that. Something a little more serious now in geopolitics. We are, of course, watching developments on the Ukrainian-Russian border. President Putin will not be talking to Prime Minister Boris Johnson, according to the Kremlin. That was supposed to happen yesterday, of course, but Boris Johnson found himself busy with other things. Russia has not sent its response, they say, to the United States and NATO just yet. So we'll look for further clarification on that front. But we do know that Anthony Blinken and Sergei Lavrov are going to be speaking again. They spoke last week. Is all of this taking tension a little bit out of the situation? Oil prices have retreated just a touch, but the Bloomberg Commodities Index still near to those record highs. More Bloomberg Surveillance is ahead. An exclusive interview with the Philadelphia Fed President Patrick Harker. Tune into that for more on the Fed and the inflation outlook. This is Bloomberg.